All right, so I want to just recap briefly the some of the stuff that we did on the flow to equity and adjusted present value, and then it won't take too long, but I'll just go over the final method of WACC, calculating a project value using the WACC and accounting for the investment cost of the project, and then I have an in-class problem that I wrote. I finished writing it this morning for that material, and so that'll give you some practice. And we haven't really done a proper in-class problem since we did Zoom. We've had a couple that were sort of like working together with me with the Excel lab, and then another one that I sort of just kind of worked through together. I'm going to try, I think today I'm going to try to just let you guys take a crack at it on your own and ask me questions, either in the chat or out loud, and we'll try to do that. I'll make a Dropbox for that assignment in just a little bit. But just before we get to that, I need to just finish covering this this last method. So just to recap, this is where we've been. We've been talking about the three methods for evaluating a CAPITY and WACC. So those differ specifically with respect to how they treat, how they compute the discount rate. Those differ with respect to how they treat the discount rate, whether they consider levered cash flows or unlevered cash flows, or whether they compute cash flows after interest has been paid or without interest being paid. Levered cash flows are just going to be the residual cash that accrues to equity holders, whereas unlevered cash flows includes the cash that goes both to equity holders and to bondholders. And then there's also the question of how to treat the initial investment. Do you subtract off the total value of the investment, or do you just subtract off the equity finance portion of the investment? So we looked at that with an example. We had a project with $200 million of revenues, $50 million of costs. So there were some operating income, there was some net income, which was taxable at 20%. And so the project cash flow after taxes was $120 million. We found the present value of that if the cost of capital for that firm was 20%, the overall cash flow or the overall value that was the 600 million, and so for 420, the net present value for the unlevered project if the project was entirely equity financed. Okay, then we used kind of this version of Modigliani and Miller proposition 1 with taxes. Here, this is kind of a version of that, except it refers to projects rather than overall firms. And so what this did is it took the net present value in the unlevered case, which we just calculated, and it tacked on the present value of the tax shield, which is just the tax rate times the amount of borrowing. We assume that borrowing occurs in perpetuity, and so that represents a flow of interest payments that are or a flow of tax savings over time, taxes that are saved because interest is tax deductible, and then the present value of that, you discount it by the cost of that debt or the interest rate, and that gives you the present value of that tax shield, and you add that on to the net present value of the unlevered firm to get the adjusted present value, which in this case was 426.32 million. So that was the first method, adjusted present value. We talked about how this lets you you have to compute the debt to equity ratio or the debt to value ratio according to the cost of the capital, or of the cost of the investment. And then this was the sort of the NPV. This is the NPV, or the extra value that was created because of that investment. It generated excess value above and beyond just the cost of the investment. So the overall value of assets was the 606. And then we know that 31.58 million of that was borrowed. And so the residual equity value was this 574.74 million. And those are figures which then allow you to figure out, the debt to value ratio and the debt to equity ratio, which come into play in this in the flow to equity method. So that, again, that method we went over it last time, but just to review that, we differentiate that method from the previous one insofar as we use levered cash flows. We calculate levered cash flows, which are revenues minus costs minus interest. Account for the residual value that accrues to equity holders, and then the rate that you discount those cash flows at is the levered discount rate, which is RS, or the cost of equity capital, which, as we saw under Modigliani and Miller Proposition 2 with taxes, that's not equal to the unlevered cost of capital. There's a formula for how to compute that, and so we did that last time. First thing we did, of course, was we computed the levered cash flows. We took the revenues, subtracted off costs, we subtracted off interest. We figured out the after interest income, which we applied the 20% tax rate to. So we found the levered cash flows equal to 117.45. This interest, again, came as a result of that we were assuming. That was the 10% interest rate. So this $120 million, which is what the unlevered cash flows were, now become 117.45. Those are the levered cash flows. That makes sense. Those are lower because of the interest payments that we're subtracting off, right? So then those are the levered cash flows. Those levered cash flows get discounted by the cost of equity specifically, and that requires you to use Modigliani and Miller Proposition 2 with taxes in order to calculate the new cost of equity capital. So taxes here, 20% was the unlevered cost of equity capital, 0.1% or 0.1 or 10% was the cost of debt. We multiply that by the debt to equity ratio. That's the S over B, which we had calculated on a previous slide, and then we multiplied that by 0.8 to get the new levered cost of capital, which is 20.44%. Okay, so that's the new rate that we're using, and then we took that over to this slide. We took the levered cash flows. So we found the PV of the levered cash flows by discounting the levered cash flows by that new cost of equity capital in the levered case. We got 574.61 million for that, and then critically, we just subtracted off the portion of the investment that was financed with the firm's own equity capital. Okay, so that was subtracting off 148.42, and we got $426.2 million for that, which was the same as what we got under the adjusted present value method. Okay, so now the third way of doing this is to just use the WACC. We're going to discount, in this case, unlevered cash flows by the project's WACC. And this is just going to be calculating WACC the same way that we had been calculating WACC before. We have some equity share. We have some debt share. We multiplied each of those shares by the respective costs of those kinds of capital. Equity share gets multiplied by the cost of equity. Debt share gets multiplied by the cost of debt, times 1 minus the tax rate if there are taxes. And so this is going to just follow the same WACC structure that we've seen before. In this case, so we've already calculated some of these numbers. We're looking for S over S plus B. We're looking for B over S plus B. You know, so S over S plus B is right here. B over S plus B is here. Finding the value of the project under the debt, and then subtracting off the amount of debt that was taken on for that project. That gave you the debt to value ratio. And then if you subtract the total value of the project minus the value of the debt, you get the value of the equity in the project. And so in either case, you know, this was 5.21% for the debt to value ratio. It was 5.4%. The debt, or for the WACC, because what we want is the debt to the value of the project under leverage. Remember, the equity value is going to change and expand as you take on more leverage and as you take advantage of the leverage tax shield or the interest tax shield. And so this is what we want here. We want this B over VL, which is 0.21 here. This 0.0521, that's B over S plus B, or you know, you could B over the value of the levered project. The equity share would be just 1 minus the debt share. That S over VL is just going to be 1 minus B over VL. Okay, so that's where this 0.9479 number comes from. Each of those gets multiplied by the costs of those types of capital. So this 0.2044, that's RS in the levered case. This 0.1 is RB, cost of debt, and then this is just 1 minus the tax rate, and we get 19.79% for the WACC under this leverage structure and under these costs of capital and costs of debt. This WACC is lower. You know, it's lower than the cost of equity capital. The cost of equity capital was 20%, and part of that is the fact that you increase the amount of debt that's involved with the project. That increases the amount of tax savings you're able to get because of the project. The tax shield effect goes up as you take on that debt. You pay interest, but some of that interest is tax deductible. And so you overall, the firm benefits from a lower cost of capital as a result of taking on that debt. This cost of capital under some leverage is a little bit lower than it was just for the unlevered all equity case. Okay, so that the unlevered cash flows, then that's the 120 million. That was the 120 million was the revenues minus the costs, minus the taxes. That was the cash flows, the unlevered cash flows. So we're using unlevered cash flows, even though the firm is levered, but we're discounting those cash flows by the WACC. And that's going to, in effect, do the same sorts of adjustments that we were doing with the adjusted present value method and the flow to equity method. So that 120 million in unlevered cash flows gets discounted by the WACC. So the unlevered cash flows, 120 million, gets discounted by the WACC. That gives you total project value of 606, And then in this case, you don't just subtract the equity portion, you actually subtract the entire value of the investment costs. And after you subtract the total value of the investment cost, you get 426.31, which is the same value that we got under either of the two methods. 426.31 million for the WAC method, for the flow to equity method, 426.2. So it's the only difference there is just due to rounding. 426.2 million for the flow to equity. And then we can go all the way back to the adjusted present value method and find that we got 426.32. Again, just a bit of a rounding difference there. So all three of these methods lets you arrive at the exact same place. So I'm going to give. I'll just pause. Are there any questions about that WAC method or anything else from that stuff before we get into the in-class problem? Okay, so why don't you guys go ahead and start working on that in-class problem. It's going to follow the same pattern of what we just scenario. So we have to think about those parameters carefully and think about what you need to adjust for this problem in order to get the solution. So yeah, this is the first time working on one of these over Zoom, but I'll be here to answer questions about it. Hopefully everyone's been able to access it. I posted it on Canvas. I believe it should be accessible to everybody on Canvas. It's just a Word document. What you can do is you can just take the Word document and if you want to, you can type your answers in that Word document and then upload that to the Dropbox after you finish it. So yeah, I'll this is a little bit more bizarre format to be doing this in, but I'll be here to answer questions about it if you have any, and hopefully you guys can learn something from working on that problem yourself. Yep. So there's a question, questions in the chat. Yeah. So the cost of unlevered equity in this case is 8.4%. So in part A, when you're trying to figure out the net present value of the project, in the event that the project is 100% equity financed, 8.4% is the rate that you'd use to discount that because we're in the unlevered scenario. A question in the chat about the debt to value ratio. In this case, it's not the ratio of the individual rates. It's going to be the ratio of the debt value. That's the 6 billion. It's going to be the ratio of that 6 billion to the overall value of the project under that debt. And so that's going to be what you can calculate that using the Modigliani and Miller proposition 1 with taxes. We had looked at that in the case of overall firm value, but it also applies to the case of the value of an individual project. So that's just the VL, that idea of finding the firm value. That's going to be the expression right here. It's the value of the unlevered project. So that's what you can calculate that in part A. The total value of the unlevered project. You don't subtract the investment cost. Just consider what the present value of those cash flows are in the unlevered case, and then consider what the present value of the tax shield is, and that's just equal to the tax rate times the amount of the debt. The tax rate times the key parameter for figuring out the debt to value ratio. And the debt to value ratio is just debt divided by the value of the project under that borrowing structure, under that amount of leverage. Okay. I cut out again. Yeah, so this is for the question in the chat, part A, we've got the NPV, which is going to be the PV of after tax income, from next year to infinity, and then minus the investment cost. So that's the NPV. That's the NPV of the first one. But that's the NPV, but this first part, that's equal to V. That's the value of the unlevered firm, is the present value, or the value of the unlevered project is the present value of all the after-tax income that accrues as a result of that project. So that's the VU that you use for the when you're trying to figure out VL. So, yeah.
For the weighted average cost of capital portion on the example problem from the slides, can you go over how you came up with that ratio that you multiply by the equity cost?
Yeah, let me try to share if I can get my screen. Essentially, if I remember right, there was $180 or $180 million worth of investment cost.
Correct.
There was $426 million worth of excess value that was created with the borrowing. There was only here we go. Is my screen visible right now?
Yes, it is.
Okay, so let's go back to that. There was 120 or 180 million of investment cost. Let's see, it actually might be helpful to think about it in this way. So we had $180 worth of investment cost. That's this cost here. And just to remind you of kind of where we were before that, we had $100 million of unlevered cash flows, which produced, in present value terms, it produced 600 million of value. And then when we subtracted the investment cost, that led to 420 million in the unlevered case. With the levered case, there's a little bit of extra value created from the tax savings, the present value of those tax savings that result. So the excess value actually goes up a little bit, and you get actually 426.32 rather than just 420 of excess value under the no leverage case. So then that's like the left hand side of the balance sheet. That's like the assets. That's the value of the assets. It's the capital and the equipment that you've purchased, plus any extra cash flows above and beyond that you generate. So that's the 60632 number. And then the 31.58, that's the debt, which is the thing that's producing those tax savings. That 31.58 is the reason why this number here is a little bit greater than 420. It's because of that borrowing. But then the residual, if we think about the definition of equity, it's the value of the assets minus the value of the debt, or the value of the liabilities. So 574.74 is the new value of equity. So these are the numbers. These are the numbers here that are relevant for the debt to equity ratio calculation. So those are what we end up using on this next slide to get the debt to value ratio. It's the excess debt to value would be the what was on that left hand side of the balance sheet, the 426 plus the 180 to give you something like 606. And then the debt is 31.58, which gets divided by that total value. The debt to equity then just takes that 606, which is 426 plus 180, and just subtracts off the equity to give you subtracts off the debt to give you the equity, and that gives you this 574.74 as the equity. And so that's what is in the denominator of the debt to equity ratio, is the 31.58 divided by the 574.74. Does that answer your question? Did that make sense?
Yeah, and then so you use that in relation to the weighted average cost of capital at the end, like for the third part of it.
Exactly. Yeah. So that's where the shares come from, is from that.
Perfect. Thank you.
It's actually the same way that you calculated the debt to equity ratio for Modigliani and Miller Proposition 2 with taxes, is you figure out the new firm value. In this case, it's the new project value, and then the equity is backed out by taking the new project value minus the debt, and then you can deal with those numbers that come out of that process to get the B over S, or the B over S plus B, or the S over S plus B.